In this video, we're going to break down the price action of the dollar index and uncover what the chart is really telling us. We'll start on the monthly time frame. As we go through this example, pay close attention to the levels. Most traders see these moves as random, but by the end of this video, you'll understand why price reacted at very specific locations. Take a look at this swing low marked by the red arrow. This is a major swing point, which means it's a level that should attract our attention. Keep this level in mind because it's going to be the key to everything we're about to see. Now here's something interesting. Once price closed below the red level, most traders would expect that level to become resistance. But look at what happened next. The very next candle didn't seem to respect the level at all. It just moved straight higher. So here's a question for you. Why did price ignore what should have been an important resistance level? Pause the video for a moment and see if you can figure it out. The answer is hidden in a lower time frame. Let's move down to the weekly chart. Look at the candle marked in yellow. This is where things start to get interesting. That bearish candle had already respected the red level within the previous monthly candle. In other words, the reaction had already happened. So when the new monthly candle formed, there was no reason for price to react to that level again. But there's another detail that most traders miss. If you look carefully, you'll notice that the yellow candle actually traded above the red level before reversing. So the question becomes, why did price turn there? Let's dig deeper. I'm going to draw a horizontal line at the high of that bearish candle. Now look to the left. Can you see the reason? It's still not very clear on the weekly chart. So let's go one step lower and move to the daily time frame. Now everything starts to make sense. First, look at the candle marked by the yellow arrow. Notice how the bearish candle reversed exactly at the red level. This is important. On the weekly chart, it looked like price simply traded through the level without respecting it. But when we zoom into the daily chart, we can see that the reaction actually happened with precision. The level was respected. The evidence was just hidden inside the higher time frame candle. Now let's look at the bullish candle marked in blue. Price rallied a little higher and then reversed. The question is, why did it stop there? Let's move the chart to the left. Look at the bullish candle marked in blue. Notice where the blue line is located. It aligns perfectly with the open price of a previous daily bullish candle. Price rallied directly into that level and reacted. Not near it. Not around it. Directly at it. This is the lesson. Price doesn't move randomly. When you study the chart closely enough, you begin to see that price is often reacting to very specific levels. What looked like a resistance failure on the monthly chart was actually a precise reaction visible on the lower time frames. This is why it's so important to analyze the market from multiple time frames and understand where the real reactions are taking place. There is a lot of information packed into this example, so I encourage you to watch this video again and study the chart for yourself. The more examples you review, the more you'll start to recognize these patterns in real time. And that's when you'll begin to see the underlying logic behind price action. Not a broad zone. Not a random range. But precise levels that price was targeting all along. If you found this analysis helpful, make sure to like the video and subscribe for more price action breakdowns. Thanks for watching, and I'll see you in the next one.